Over the last several decades, the idea of being able to live off of dividends has largely been viewed as being a pipe dream for most, with the average S&P 500 dividend stock only yielding 1.29% in December of 2021. The thought of being able to not only fund a retirement using only the proceeds from dividend payments, or even being able to retire early and live off of dividends sounds ludicrous in today's world. Looking at the historical dividend yield chart, we can see that the average dividend paid to shareholders is currently near an all-time low. Back in the early 1980s, companies used to pay significantly more dividends to shareholders, which averaged over 6%. And if we look back even further to the 1950s, companies would regularly pay dividends of over 7% or more. So the question we need to ask is, exactly how much money would you need to save in order to live off of dividends if you could only expect a 1.29% dividend yield? To use a very basic example, let's say you want to earn a pre-tax amount of $40,000 per year in dividends, which is roughly $3,333 a month. According to the calculator at Smart Asset, with a 1.29% yield, you would have to have $3,100,775 saved up in order to have enough money to earn $40,000 per year in dividends with an average S&P 500 dividend yield. And again, that's before taxes if you were to do this outside of a retirement brokerage account. It's pretty obvious that that's not attainable for 99% of people. According to a recent study from Georgetown University's Center on Education, the average US American with a bachelor's degree can expect to earn roughly $2.8 million over the entirety of their lives, whereas those who only have a high school education can only expect to earn $1.6 million over the course of their careers. And that obviously doesn't take into account your expenses like mortgage payments, children, vacations, and your basic groceries and utilities over the span of your life. So even if you have a bachelor's degree and you were to save every penny you ever made, you still wouldn't have enough money to save up that $3.1 million to live a modest life on dividend distributions. Now, what most people choose to do is invest in dividend growth stocks or ETFs and simply build up their portfolios over the years. And the truth is, there's absolutely nothing wrong with this approach to investing, especially if you're younger. It's a good strategy to put money in every month into a dividend ETF or say an index fund and simply wait for your money to grow. But we do need to consider a couple of hard facts here. First of all, if you plan to do your investing in a retirement account which has yearly maximum contribution limits, you better be a pretty good stock trader in order to save up the millions you'll need in order to live off of dividends. Either that, or hopefully you started investing in an index fund really early and up to the contribution limit every year. If we look at the medium IRA balance for those between the ages of 55 and 64, we can see that it's only $120,000. It's clearly not enough to live off of dividends or even enough to sell the principal to live off of for a long period of time. But now you might be thinking, what if I invest in something like an index fund in a non-retirement account on a consistent basis and then live off the principal later? Again, there's absolutely nothing wrong with doing this. This is probably one of the most, if not the most popular ways of investing in the stock market. But there is something important to consider. Every time you have to sell shares to fund your retirement during a down market, you have to sell many more shares in order to cover your living expenses. So after hearing all this discouraging news, you're probably saying, okay, how on earth could it possibly be easier than ever to earn enough money from dividend stocks to not only retire off of, but even possibly retire early in life? And the answer to that is, there's been two major things that have been happening in the stock market, one of which has happened within the last few years, and another major event is currently going on right now as we speak. We'll start with the first point, which is there now exist new investment vehicles that offer insanely high and dependable dividend distributions. If you're an experienced dividend investor, you're probably familiar with certain types of companies that are designed to provide investors with an above-average dividend yield. These would include stocks like REITs or real estate investment trusts, which typically yield around 4%, or business development companies that yield around 7 to 8% on average. You can also invest in preferred shares of certain companies that yield around 6 to 7% as well. But one type of investment that provides a dividend yield all the way up to 12 and even 13% or more are what's known as covered call ETFs. These are still a relatively new type of investment, with the first covered call ETF being launched back in 2013, and now more companies including JP Morgan and Nationwide have been introducing their own versions of these types of funds. These ETFs use what's referred to as a covered call investment strategy, where the fund buys a basket of stocks in an index and then also sells call options that corresponds to that basket of stocks. These options are sold every month, and the option premiums are passed on to shareholders in the form of dividends. And what we as investors get are insanely high dividends every single month. Some of the most popular covered call funds would include QYLD, JEPI, XYLD, and RYLD. The only downside about most of these funds is that they don't offer hardly any growth at all. In fact, many of these covered call funds don't experience any share price appreciation. But with such massive dividend payments, this actually makes up for the lackluster share price appreciation. With a 12 or 13% dividend yield when you're reinvesting your dividends, this will result in a massive dividend snowball being formed. Let's take a closer look at RYLD, which is the Global X Russell 2000 covered call ETF. This fund seeks to track the performance of the SIBO Russell 2000 Buy Right Index. It currently offers a dividend yield of 13.3% due to all the extreme market volatility we've been experiencing. Despite the share price performance basically flatlining, it has offered investors a dependable dividend distribution typically ranging between 20 and 25 cents every single month. Even as we've been experiencing crazy market volatility starting in December, RYLD has still delivered a dividend distribution during this period in that range. With that being analyzed, covered call ETFs continue to be one of the best methods of earning high dividend income every single month. There's been a growing movement on Reddit called QYLD Gang, which is full of covered call ETF fanatics who invest in them as a means to retire early, fund other investments, or people who simply love the high dividend distributions. If you really struggle with the motivation to pursue dividend investing, but you're fully aware of how incredibly beneficial it is, it might be because you don't find the small quarterly distributions of $2 or $3 by Johnson & Johnson stock all that motivating. These ETFs can definitely help you live off dividends much sooner in life. Rather than needing $3.1 million in order to earn $40,000 per year, with RYLD you would only need to invest $315,974.75 into RYLD to earn roughly $40,000 per year, assuming you were to be paid 24 cents per share per month. It's a whole lot more realistic, and if you don't have $315,000, simply getting started and reinvesting those monthly dividends will help build up a large position in RYLD. Or you can build up a large position in a growth ETF and then transfer it over to RYLD when you are ready to retire. With that being said, these new covered call ETFs are a godsend for people who want to live off dividends much sooner in life and with much less money. But like I said earlier, there's two things that are making living off dividends much easier. The second major event is what's going on right now in Ukraine. We're all aware of Putin's invasion into the country as it's still an ongoing crisis, but what people might not be aware of is just the devastating effect that this has had on the stock market and probably will continue to have into the future. As of the making of this video, the S&P 500 is down almost 14% from the start of the year, largely in part due to what's going on in Ukraine. This has sent stock prices across most sectors down quite a bit, and many dividend stocks are now trading at a discount, including covered call ETFs. But if that's not your style of investing, one example would be Store Capital, ticker symbol STOR, which is also one of Warren Buffett's stocks that's currently in his portfolio. Thanks in part to the stock market sell-off, this stock now offers an impressive 5.28% dividend yield. Not too long ago, it was yielding less than 4%, but the volatility in the markets has sent the yield rising. And if the stock market as a whole keeps trending downward, even more dividend stocks are going to be selling at a discount and thus offer higher dividend yields, which will allow people to buy more shares and collect more dividends. Don't get me wrong, I don't support what's going on right now in Ukraine, nor do I wish any bad things would happen to anybody, but as an investor, much like all of you, whenever I see opportunities to get in on an investment at a discount, I'm gonna jump in. So while I don't hope for bad things, if they do happen, I will take advantage of the situation. And as we've seen so far, many stocks and ETFs are already at a discount. If this conflict keeps going like I suspect it will, sectors will continue to struggle for the time being and will create even more opportunities to buy dividend stocks. The increase of fuel prices is something that's going to affect nearly every single sector. I'm not trying to predict a recession or anything, but I personally think that we're going to be in a rut for a while. If you do plan to invest money in dividend stocks, one suggestion I'd make is to invest in dividend aristocrats. These are stocks that have increased their dividends once a year for at least 25 consecutive years. These kinds of stocks are considered safer than other dividend stocks, and although they typically come with pretty boring 2 to 3% dividend yields, during market sell-offs, this can actually result in their dividend yields growing to 4 or even 5% or more. In summary, being able to live off of dividends is the absolute best form of passive income in my opinion. Although there are other forms of earning passive income like owning rental properties or writing your own book, nothing comes close to beating dividend income as a means of earning passive income. It requires the absolute least amount of work in order to earn money from it. With rental properties, you still have to go through the long process of buying the property, fixing things, finding tenants, managing the property, and so on. With more creative forms of passive income like writing a book or selling your own stock photos requires time to actually create something that enough people are going to want to pay money for. But with dividend investing, all you have to do is deposit money into a brokerage account and simply buy shares of dividend stocks or funds and just sit back and relax and let the money come in. For those of you who are serious about pursuing this way of investing, my advice would be to consider these two events and plan your investing accordingly. Feel free to check out some of the other videos on my channel where I typically cover higher yielding dividend stocks, ETFs, closed-end funds, and so on. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below and click subscribe if you want to see more dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that content. Alright everyone, thanks again for watching, and I'll catch you next time. Take care.